market news now. Asian stocks are headed for their worst week in 3 months as a string of hotter than expected inflation prints and hawkish central bank surprises made investors nervous about the economic toll of taming runaway prices. The rand weakened against the US dollar in early trade as concerns about the global economic growth weighed on risk sentiment. Meanwhile, in the oil market, oil is headed for a weekly loss of over 4% after the Federal Reserve signaled that further rate hikes were needed. The drop has come despite production cuts from OPEC and its allies. To talk to us a little bit more about the markets, we are joined by Garabile Nonyana from EA Capital. Garabile, thank you so much for your time. So to what extent have you had to, I suppose, relook at your inflation expectations given this rhetoric turnaround, this hawkish turnaround that we've seen from a lot of the central banks?
I don't think it is a relook at inflation. It's just looking at what is the composite movers in this inflation print. And what we're finding in the global north as well as in the west is that there is quite sticky inflation. And this sticky inflation is first of all led by supply side shocks as well as labor constraints in the US. So when we're re-looking at our models here at EA Capital, what we have revised is the inflation outlook, meaning that inflation might not be hotter in the future, but might remain at these elevated levels for longer, which I think the market has not yet priced in.
Speaking of the market, I mean, we've had a couple of bits of Fed speak. We'll probably have more going into next week. What are or were you looking for that could be a seminal moment for the markets?
I think the market right now is looking for any confidence, and I think it is stuck in a crisis of confidence. And I think when the market was looking at Jerome Powell's testimony in Congress, what they were looking for are any changes to the way he's viewing monetary policy. And right now, we do have certainty as market participants that there'll be at least 2 more rate hikes in 2023. The quantum of those rate hikes is yet to be seen because I think all those rate hikes will be very data dependent. And I think that's how the rest of global central banks, ex-China, are looking at inflation. That data will be the driver of monetary policy going into the future.
As we, I suppose, go into the second half of the year and it really gets into full swing, what are your expectations for the economic backdrop or the macroeconomic backdrop and what it means for markets? Let's start off with South Africa and then move on to the States.
I mean, I was listening to the Reserve Bank governor speaking a couple of days ago, and he really was talking about the constraints in which our South African economy is having because of load shedding. And he said that if it was not for load shedding, we'd be growing at about 2.3%. And thinking that our economy is back to above pre-pandemic levels, that was going to be positive and really, really good for product. But what I'm trying to see in the South African economy from the latest GDP print is where are we going to find this growth? Because you're finding in most sectors, whether service or primary sectors, that you're seeing stagnating growth, even negative growth in some of the sectors in the economy. For an economy to grow, you need either innovation or industry, and that's something that we're not seeing from the South African economy. Looking to the rest of the globe, I do anticipate to seeing slowing economic growth outside of Europe as well as in North America. But I do believe that there will be some positive change in China. As looking at during the week that they did cut the benchmark interest rate by 100 basis points, trying to shore up that economy. But I think at the Politburo of the Chinese Communist Party, there will be some stimulus that will be announced in order to lead global growth.
Are there sectors that are not in vogue anymore, or where are you seeing opportunities?
I think there's opportunities in emerging markets at the moment. I mean, looking at the S&P 500 from the lows it saw last year in October, it's almost up close to 20%. And even we in that region, then we must be speaking of a bull market. And looking at our market, looking at the highs, we also see that all share index was close to about 77,000 points at the beginning of the week. albeit it lost about 3,500 points already this week. But that's showing how much the market has run. And what you're seeing is that global diversifieds locally are doing so well, and the Rand hedge stocks are doing very well, and the rest of the market is looking very cheap, particularly speaking about financials. And for me, this is the time to even start putting some resource counters into one's portfolio.
All right, Garabile, I would have loved to talk to you about some of the themes as you look back at the week that was, but unfortunately we have run out of time. Thank you so much for making time to unpack some of those dynamics. That is Garabile Nonyana, who is the head of global markets at EA Capital. We're going to take a quick break. When we come back, we'll have SME on point, so stay tuned.